And it is a great pleasure for me to welcome you to this very special launch event made possible through a partnership with Climate Bonds Initiative. We're delighted that many of you have joined us today, and we see this as a proof of the great interest that our latest initiative is garnering in the market. But before going any further, let me extend a particular welcome and also my thanks to our guest speaker, Mr. Sean Kidney, CEO from the Climate Bonds Initiative, and also Mr. Robert Eigener, Head of Capital Markets and Head of Treasury and Asset Management at Eurofima, for joining us virtually today, as we unveil to the world the newest dimension of the Luxembourg Green Exchange, also known as LGX. And I'm sure you're all eager to know more about this new dimension, but let us first take a very short step back and see where we're coming from. In 2016, LGX was launched as a platform dedicated exclusively to green bonds. 5 years later, with more than 930 sustainable securities displayed, totaling north of 417 billion euros equivalent, we are struck by the extraordinary expansion that LGX has gone through since its early days. It's an impressive and a transformative journey that very few could have predicted at the time. And indeed, as the sustainable finance market developed and as investors' interest into responsible investments grew stronger, LGX kept adapting, showing its agility to meet the evolving needs of issuers and investors by proposing a more diverse series of financial sustainable instruments to display. Today, LGX covers green, social, sustainability, and sustainability-linked bonds, as well as socially responsible investment funds, which all together form a very comprehensive product range. LGX is also, by a large amount, the world's leading platform for sustainable finance. And as such, it provides great visibility to those sustainable securities it displays, but also to the issuers of sustainable products. And by the same token, LGX also makes it easy for ESG-oriented investors to access a broad range of investment options through which they can contribute to positive social and environmental outcomes. 2020 was also a year of great innovation at LGX, as we started complementing our core offering with value-added solutions. In May, we established the Lgx Academy, which seeks to strengthen the sustainable finance education among professionals in the financial industry. And a few months later, in September, we launched the Lgx Data Hub, which is a unique offering on its own. And the Lgx Data Hub consists in a centralized database of structured sustainability data covering more than 3,000 sustainable bonds from 800 issuers. And the Lgx Data Hub allows the asset managers and the asset owners to actually extract, compare, and process the social and environmental impact of sustainable investments, and also help them to comply with their reporting obligations. With today's launch, we want to bring back the focus to the core of LGX, namely the display of climate-aligned investment opportunities. And it is my great honor to announce that we are now officially extending the scope of LGX beyond the product dimension to add a new section dedicated to issuers, to begin with climate-aligned issuers. Ladies and gentlemen, let me introduce Climate Bonds LGX Climate-Aligned Issuers. This brand new section, made possible through our partnership with Climate Bond Initiative and leveraging the issuer research and screening methodology they have, shines a light on climate-aligned issuers, i.e. issuers that by the very nature of their activity and their revenue streams contribute directly to meet the global climate goals. In a few minutes, Sean Kidney will tell us more about the methodology and the research that is performed on those companies by CBI. We will also hear from Julie Becker, our Deputy CEO and the founder of LGX, why it is important for our exchange to actually display and make available these untapped opportunities in the wider sustainable world. We will finally have the pleasure to hear from Robert Agonair the views of a climate-aligned issuers and how this actual development from LGX can be relevant in the context of their funding strategy. By moving beyond the label space, whilst ensuring the integrity of the issuer assessment through the Climate Bonds Initiative in-depth research and analysis, our Climate Bonds-LGX Climate-Aligned Issuers section will provide investors who wish to contribute to the fight against climate change with a broader range of options and more supply, which is of particular relevance at a time where the demand for ESG product sees unprecedented rise. So without further ado, I would like to hand the virtual stage over to my colleague Chiara Caprioli, who will take us on a guided tour of this exciting new product launch. And before ending to Chiara, I would also invite all our attendees to certainly don't be shy and submit their questions, making use of the Q&A functionality that they can see on the application, and we'll address them in the Q&A at the end of the webinar. Chiara, over to you.
Thank you so much, Arnaud. That gives a very fair view of what an extraordinary journey Lgx has been so far, if you look back at this nearly 5 years. So moving on to the core of the debate today, we will little by little uncover what's behind the climate-aligned issuers section of Lgx. And I'm happy to share the virtual floor with our Deputy CEO, Julie Becker. Julie has been appointed to become CEO as from April this year. So congratulations, Julie, for the promotion, the move. And we will have Sean Kidney that has just joined us from the other side of the globe, from Australia. So thanks, Sean, for spending your evening with us, and we're very grateful for your time, given the time zone difference especially. I would like to go back on what Arnaud introduced. We have set up Lgx with a clear idea to create visibility around those debt security that come to market with strong features of transparency and that abide to international standards. So far, this has meant securities within the labeled space. So use of proceeds securities on one side, green bonds, social bonds, sustainability bonds, and general corporate purposes securities on the other side, a bit more recently, in the form of sustainability linked bonds. So those bonds that are general bonds, but that come to market with the promise of impact and that go as far as to promising compensation in case impact for whatever reason cannot be achieved. Today's move to go beyond the label space and to include products that are defined by the issuer's nature and activities rather than the product features itself is a bold move. It's allowing us to venture into new areas, and it does somehow herald a shift in the Lgx philosophy. So I'm turning to Julie to uncover what is the vision behind this move. What is it that we're trying to achieve here? Julie?
Thank you, Chiara. Good morning, all, and thank you for joining us this morning. Well, what's the vision to move beyond the label space? Well, I would say that it's all about channeling capital where it is more needed, and at the end, uncovering strong investment opportunities within the ESG space. It is now very well known by all of us that if we want to achieve the UN SDGs and the Paris Climate Agreement goals, unprecedented sums of money are still needed, requiring a massive contribution from private investments. $11.5 trillion is needed to meet all UN SDG by 2030, and 6.9 trillion euro is needed each year to meet the goals of the Paris Agreement. And exchanges have a key role to play in redirecting capital towards sustainable projects. As a service provider for capital markets and sustainable capital markets, our goal is to cater for market needs. And as you know, today's investors want to invest in accordance with their own values and convictions. And institutional investors will even be pressurized towards solving the climate urgency by the upcoming European Sustainable Finance regulations everybody's really focused on so far. So the issue is that investment opportunities currently available within the field of climate finance are simply not enough. Investors are calling for more supply and diversity of products that can contribute to climate objectives. And there is simply not enough labeled green bonds issued today to respond to investors' appetite in sustainable debt securities. That's the issue today. The universe of labeled products is not big enough to mobilize the capital needed to accelerate the transition to a low carbon economy, nor to satisfy the investor appetite for sustainable investments. And as an exchange, our duty is to provide both issuers and investors with the opportunity to bridge this gap and scale up efforts. And what we want is to bring awareness that sustainable finance is not limited to labeled green, social, and sustainability bonds only. We want to uncover new sustainable finance investment opportunities that have so far been invisible as not packaged within labeled products. And so by adding a new issuer section on LGX, just next to the existing product section, we want to bring more visibility to financial instruments that have a positive impact on our planet, even if they are not explicitly labeled as green. So we want to make the investor community aware that more instruments than just labeled bond have the potential as well to contribute positively to the climate transition. And by the way, the outstanding debt of climate-aligned issuers represent a huge part of the total climate finance market. And Sean, if I remember well, I think it was in 2018 that CBI led a survey and estimated that the entire climate-aligned debt instruments stood at that time at $1.45, of which only $389 billion was made up by labeled green bonds, which means that over $1 trillion were unlabeled bonds. So the unlabeled part of climate-aligned debt instruments is 4 times bigger than the labeled one. But this is yet not visible enough for the environmentally friendly investor community.
That's correct, Julie. We are trying to uncover a very impressive dimension of potentially new product that could be of interest for investors with ESG mandates. I've seen Sean that is eager to take the floor, and I want to say that we can only be doing this today thanks to our partnership with CBI. We will actually be relying on CBI methodology for the selection of this climate-aligned issues universe. Sean, your methodology has been out there for some time, since 2012. It's been the first in the market and is definitely the reference in the market. Now, even before going into the details of how this is made possible, could you tell us how CBI had the idea 15 years ago to come to market with such a classification scheme? And I guess also that this methodology has been evolving since then and is still evolving and is set to evolve. Please.
Sure. Look, the idea is simply to identify investments that are utterly consistent with climate, with our Paris Agreement commitments, that need to be considered within investment portfolios of asset managers and fund managers around the world. And what we wanted to do was to grow amongst the community an appreciation that investments were actually there, that if they were concerned around climate and climate risk, as was happening, that this wasn't a matter of waiting for a niche product to develop, that, you know what, Eurofema was already out there. And Eurofema's bonds were climate-aligned bonds and needed to be understood as such because they were being used entirely for electric transport, rail transport of various sorts that was totally consistent. Now, this took a bit of educating, I'm going to say. You know, I can remember an investor conference in about 2013 when one asset manager came up to me and said, "Sean, these trains, they're dirty, aren't they? Why are they clean?" And we had to say, well, transport emissions make up 1/4 of the world's energy emissions. and shifting to low carbon transport is utterly critical, and so on and so on. And now, of course, we have a large, very healthy labeled transport market, which is great. The labeling helps people. Investors like the formality, the particular aspects of it, but that doesn't mean that Eurofema's unlabeled bonds are not climate-aligned bonds. Let's be clear here. If we have confidence about where the money's going, we need to consider that, obviously, an investment that counts. And under the European taxonomy, we'll now see this becoming a bit more visible, because in the disclosure regime that is being applied in Europe for corporations, investors, and banks, they will be asked to disclose the sustainable investments in line with the taxonomy, whether they issue labeled product or not. So Eurofema's portfolio, and I'm obviously looking at Robert here because I'm waiting to hear what he's going to say a little later, Eurofema's investment portfolio, or rather bond portfolio, would then all qualify under that model. And an investor like Union Investments in Frankfurt would then be able to disclose all of those holdings against the taxonomy. So this is a bit different to the labelled market. But I want to stress, we still have a lot of interest and a lot of appetite for labelled bonds because of the formality of independent review and reporting in areas where it's not so certain what is green, like transport, adds a significant amount of comfort to investors about the use of proceeds. So it'll stay there. But yeah, I just want to say, let's not forget that there are many investors that count already, and that's what we try to do. And sorry, Chiara, I just have to say, which is why I was so excited many years ago when I met Julie Becker, when I had a chance with Pierre Gramegna on the stage of a performance venue in Luxembourg to be part of the launch of Luxembourg Green Exchange. It was such a cool moment. And I have to say, it is so cool to be here many years later, to bask in the glow of your success. So thank you for the work you've done. And thank you, Julie, for the work I know you will continue to do to grow this fantastic venture.
We all remember that day very well. So, Sean, what you're saying is that there is some continuity because we will go back to origin. Before the labeled, trend was there. There was already a natural pool of climate-aligned issuers on which we are now going back to make sure that they can stand out and be visible to investors as legitimate ESG investment opportunities. Now, I'm sure our audience will want to know how the selection takes place. So how is it that an issuer ends up to be considered climate aligned by the standards that CBI is actually having in place?
So we use what is essentially a science-derived framework, which you will see echoed, by the way, in EU taxonomy, because we've been active in growing that and explaining how to do this. We look at what are the pathways, what used to be called Sokolo's and Pakolo's wedges of change and climate change, the areas where investment is required. And then we look at companies that are in those sectors, such as transport companies, obviously energy companies. We look at a range of different sectors, buildings, that is very green buildings, water, waste, land use, agriculture, adaptation, even ICT. We then look within the universe, and this takes an awful lot of scouring across the databases of the world. We then look in the universe for companies that are at least 75% exposed in their revenues towards those climate-related investments. So pretty green, they're strongly aligned. And then we talk about companies that are more than 95% aligned, which is what we call fully aligned. And that we differentiate between the two. But the overall universe, which is about more than $1 trillion US outstanding at the moment, is a mixture of those two. In identifying what are the right kinds of investments, we link it back to an examination of the necessary ambition that is required to achieve our Paris Agreement targets based on the work of the IPCC, notably the 2018 1.5 degrees Celsius report, the IEA with their 1.5 degree modelling, most importantly, but modelling and other models. And we reference some working groups were created to look at these issues, such as a transport working group of experts around the world, a water working group. So I'm going to say it's a slightly long and laborious process to come up with a rule set that we can have confidence about. We'll find investments consistent with the Paris Agreement, but it's very much tied to what climate science is telling us we need to do in these sectors, which does lead to some hard decisions sometimes. We have, for example, now excluded hybrid vehicles from inclusion in this, but we've included electric and electric plug-ins, which are hybrids as well, but with a bit lower emissions level, because of what's seen as the transitions pathway in the transport sector, and so on. So you are drawing a line to demarcate what should and shouldn't be in necessarily in this sort of process, and that underpins our examination of issuers and, of course, the bonds that that are created by those issuers. Does that make sense, Chiara?
It does. I mean, you mentioned science, and I think the science-backed approach at CBI is what allows us to give, at the end of the day, comfort to the investors that the company that end up in this pool of selected climate-aligned issuers is actually there because of their level of ambition and because of their substantial contribution via their activity to climate-aligned goals. So that's a very strong point. Now, you mentioned sectors. I know there are 8 sectors that you are starting to observe before drilling down the level of companies. Some of these sectors are, I would say, obviously within climate-related activities. Some others are a bit less so, or they're a bit less obvious to the known experts. You mentioned ICT. How would you justify that ICT as a sector, or maybe just some companies within ICT, can be considered to be strongly, if not fully aligned climate issues?
Well, there are 3 kinds, at least 3 kinds of investments in the ICT sector that we need to be seriously supporting if we're to achieve our climate goals. I mean, first, the rolling out of fiber optic and high bandwidth fiber optic and 5G connections, for that matter, significantly increases the capacity of society to be able to use internet connections and reduces the need for other kinds of activities. I mean, let's face it, the better the quality, the video conferencing we can do, the fewer the meetings we can actually have. We'll still need meetings, but we've learned this year, in this last year, thanks to the unfortunate circumstances we find ourselves in, that we can do without a lot of them. But that's only because we've had good fiber optic in many places of the world. In some parts where that isn't there, the interaction with the rest of the world has been substantially hampered. Now, this is an example of why fiber optic is. In a report that one telephone company did a few years ago, they looked at the emission savings from the application of fiber optic, including just replacing copper, and it was extraordinary. So that's the background of there. The second part is in data centers. So data centers consume some 3% of the world's electricity at the moment, and it's rising like a rocket. Now, if you're running data centers inefficiently or off a coal-fired grid, this is a problem. If you're doing them very efficiently, and in the EU taxonomy, we've indicated minimum energy efficiency guidelines for data centers, or running them off renewable energy grids, that helps enormously in terms of mitigation. And then lastly, sort of cute story, which is the application of software. In my work in the platform, and I don't know, Julie, whether you remember this from the TEG meetings actually, we got told a story which we included in our deliberations about eBay investing in software development. So when eBay rewrote all its code 3 years ago or so, from which they hadn't done since the launch of eBay many, many years ago, they found that when they rolled it out across all the data centers, the efficiency improvements were up to 95%. Now, when you consider the emissions, the power footprint of data centers, that's actually extraordinary, let alone all the other things. So there are software applications too we need to consider. Now, of course, finding those in companies is a little bit of a challenge. There are some, but you get the idea behind the thinking. And of course, there are other flavors. So in each of these areas, we have determined, critically importantly to do so, that there are significant contributions to be made to address Paris Agreement targets, not just mitigation, but I need to stress also an adaptation and resilience. Now, finding investments that are appropriately ambitious is a little tougher in that sector, but this is the work our research team are doing.
Great, thanks. It's very insightful to hear about this example. I think they resonate with most of us nowadays. And it goes back to our main point. At the end of the day, what we are doing is done to uncover this universe that is still not so visible, that is still not understood even by the market, by having it pre-assessed, pre-analyzed, and classified as applicable investment opportunities via the Lgx platform. I think that the methodology is clear enough. It does give us a safe layer of selection to investors by making our role of bridging ESG opportunities with where the money is and with issuers that are having an interest to be more visible to a broader base of investors. I think so far so good. The benefits for the market are there. I think it's a win-win situation. Now, I would like to play for 1 second the devil's advocate. And to do that, I will need to turn to Julie again. We are admitting to the platform instruments which are not supposed to do any kind of reporting. They are general corporate purposes instruments. They are climate-aligned bonds. They can, of course, if they want, come with additional layer of reporting, but there isn't such expectations in the market because they are not labeled to do so. Now, Lgx so far has all been about transparency. The securities that have been admitted because of their commitment to reporting on an ongoing basis. Isn't there a contradiction in what we're doing, or can we say there is a positive discrimination we're doing in favor of this new instrument that CBI is giving us the chance to identify? What's your view on that, Judy?
Well, Chiara, if I may, to answer your question, I wouldn't want to refer to a positive discrimination, but rather to a positive action to unlock additional capital in the right direction. To be clear, we are not creating any sort of artificial competition between labeled and unlabeled universities because they are fundamentally and inherently different. So, however, the philosophy is still the same than when we created the Green Exchange back in 2016, and that Sean was just mentioning that time. At that time, yet the market was all about use of proceeds products, and our role at that time was to encourage disclosure at the level of projects financed via green bonds, as to provide investor comfort about the destination and even better the impact of the funds. But in the debt space, there was not so much interest to look into the issuer's general activity or the revenue streams. And as an exchange and as a neutral platform, we haven't wanted, and we still do not want, to judge the profile of issuers. What we want now is to make it transparent and accessible. And today it happens that for some issuers, it wouldn't make much sense to finance specific green projects per se, whereas their overall activity or revenue streams are climate aligned by nature. So should we exclude them from the climate aligned investment opportunities? I think the idea is, on the contrary, to bring more visibility to them, especially those climate aligned issuers who do not have specific projects to finance and such cannot always issue some labeled bonds to finance them. And the idea is, on the contrary, to offer those issuers a more diversified investor base, and at the same time bring an additional pool of climate-aligned investment opportunities to ESG-friendly investor community beyond labeled products. And as for transparency and this tricky question, based on the issuer screening, as just explained by Sean, which is science-based and based also on their assessment methodology, which is made publicly available, we will display on the Green platform, on the issuer section now of Lgx, the level of the climate alignment of an issuer with the exact percentage of alignment. So the year of the last alignment evaluation, which happens to be done on a yearly basis, and also the list of securities that have been issued by a climate-aligned issuers. And as you were just mentioning, Chiara, that could be either labeled or unlabeled bond. And this distinction will be made very, very clear. So it will be done in full transparency. And so you see transparency is there, but it is now located and in this issuer section at the level of the issuer's assessment rather than on the details of the projects to be financed via the proceeds of the bond. The transparency now can be assessed at multiple layers and holistically. And the trend in the market is clearly about increasingly screening entities in different ways and at different levels, at the level of the decarbonization pathways, about the sustainability strategies, the sector of revenues from operational activities, and the level of transparency we are now promoting by offering a legitimate place to climate-aligned issuers is part of the same move to show broader indicators of transparency than just use of proceeds. So to conclude, let's not forget as well that investors are different. Some might prefer transparency at the level of the use of proceeds, at the level of the product, while others might prefer a view on the company's activities and long-term orientation to sustainability objectives. And I remember very well a multilateral development bank acting not as an issuer at that time, but as an investor, explaining me that it was very good to invest in green projects and green products. But it was a woman, and she was really strongly explaining that this was not enough for her, that she wanted to understand what was the profile and the overall sustainability strategy of the issuer. So again, I would insist on the fact that the role of an exchange is not to relieve investors of their responsibility with regard to their investment choices, but to make as much information as possible available to investors in order to allow them to make informed investment decisions.
Absolutely, Julie. And there is one strong statement that you made, which I would like to serve on again, which is transparency will continue to be there. It will be even stronger because it will not just be limited at the level of the projects financed via the bonds, which we have seen so far, but it will go into a new area, which is the area of the entity, the level of ambitions, the substantial contribution to climate-aligned objectives, you name it. It might just be the beginning of a trend that will become more and more solid in the next few years. And we've seen new products such as transition bonds, sustainability-linked bonds. They give a lot more of importance to entity-level considerations in a way that it's readdressing the whole way to look at the overall debt products. Sean, would you tend to agree with us, or do you have any other different views on this transparency or the way it is interpreted in the interest, of course, of market sound investment decisions?
Look, to shift our economy as quickly as we have to shift it, and I'll reference the European Commission's 2030 goals of 55% reductions on 1990 levels, which is an incredible target. This is tough. And that needs to be a global target. We've got to work up everything available to us. We need to look at CapEx investments made by individual companies. We need to look at companies themselves that can be transitioned and looked at. This particular tool gives us a tool to look at companies. If a company is 95% in the fully aligned category, that's effectively a pure play. So I'm going to suggest all of their bonds, as we have put in this listing, all of their bonds can be used. Whether they consider themselves green or not is a secondary issue. We are simply saying this company, hey, Robert, you're a female again, this company is doing the right thing and it needs supporting in this way. And that should also apply to equity investments and so on. Now, there's scope to do a lot more about this if a company says it's going to keep doing the right thing, or let's say improve it. Let's take a company that might be 75% aligned or thereabout, something like Canadian Pacific Railways, and they're going to move to 100%. They might issue a sustainable link bond. They might make all their bonds sustainable link bond, where there's a coupon variation, that is a penalty if they don't achieve the targets or something along those lines. This is where instruments are going, and we're seeing a lot of talk and a lot of action around these areas. To do that, we have to know how green is the company and how green it's becoming and be able to report on that. That visibility and that transparency is aided by the formality of reporting mechanisms, but honestly, we can investigate sometimes, and that's still entirely valid. If you're a company like PGGM or Allianz Global Investors, the point is to invest in climate, not to invest in instruments necessarily. It's to invest in places that will make a difference to the future of our planet. And this is what this is. This is a growing the universe tool. So we've got the green, we've got the sustainable, we've got the social, and now we've got the climate aligned. It just tells investors there are a lot of places you can put your money in. And in a sense,
at the end of the day,
there's no excuse not to.
Money is going, right?
That's right.
Thank you so much for, as insightful as this conversation is, I propose we take it back in the Q&A sessions, and unfortunately, I will have to stop it here for the time being, but I will leave the floor without further ado to my colleague, Carlo. Carlo is Head of Relationship Management, and you will be conducting an interview or a debate with one of our first climate-aligned issuer, which is Eurofima. Carlo, I hope you're ready. Floor is yours.
Yes, absolutely. Thank you very much, Chiara. So, yeah, after this very interesting debate, I'm now very pleased to welcome Robert Eigenherr, who represents one of our first issuers today, Eurofima. For those of you who do not necessarily know what who Eurofima is, Eurofima is the European company for the financing of railroad rolling stock. It is a supranational organization with the primary purpose of financing the acquisition and also the modernization of railway equipment by its shareholders. So, Robert has a broad experience in financing railway equipment, first at the Swiss Federal Railways and now at Eurofima. As it has been said in the introduction, Robert heads the capital markets department that covers the funding activities, but also the investor relations, and I think that's also an important part for this discussion, as well as the treasury and asset management department. He's also in charge of liquidity management and investments. And his focus is today on aligning Eurofima's financial market activities towards a holistic, sustainable finance. So very interesting in that respect. Robert, thank you very much for being with us today. As we have heard already from Joan, transport remains one of the important and dominant themes in the climate-aligned universe. How important would you say is railway transportation in this context?
Good morning, everyone, and thanks you for the opportunity to speak here. As Sean already said, transportation is one of the major sources of greenhouse gas emissions. And in this sector, rail is the most energy efficient way of transportation, and it also has one of the lowest greenhouse gas intensity among the different ways of transportations. So to me, there is no doubt that railway transportation will play an important role in the development of sustainable transportation solutions in order to achieve our global climate targets. And just to provide you with some figures, Eurofima helped its member railways to save more than 150 million tons of CO2 emissions with our loans that they basically use to renew and modernize their equipment.
Oh, very interesting, thank you. Now, if we look at your financing activities, and Sean has already mentioned it, Eurofima as a climate-aligned issuer is issuing both labeled and also non-labeled bonds. Can you tell us why you had decided to issue labeled bonds and why you continue also to issue non-labeled bonds?
Mm-hmm. So we are active in the global capital markets for two reasons. First and foremost is to raise funds for our railways. We provide then loans and they basically pledge their trains. And that's then the assets that we use to issue green bonds. But we are also in the capital markets for our internal liquidity purposes. And there we basically lack the green eligible assets. And that's why we issue in a non-labeled format. But the latter, that raised really our internal discussion, because what we did is we aligned all the investment activities towards sustainability. So we signed the UN Principles for Responsible Investments. We integrate ESG considerations in our investment process. And then the question is for me, so what is the difference between a labeled and a non-labeled bond if our complete business model is towards sustainability? And that's basically for me then exactly where LGX steps in with this initiative.
Very interesting, thank you, Robert. Now, as we know, funding costs is always an important topic when it comes to comparing labeled and non-labeled bonds. For you as an issuer, would you say that there is a cost difference between the two types of bonds, so the labeled ones and the non-labeled ones?
Yes, this is a very difficult question, and there is a huge debate about the answer, and also my answer is it depends. And it really depends on the issuer on the one hand, but also on the supply that an issuer provides in terms of green bonds. So I can give you an example. Eurofima is only issuing in green format in euro. So our funding curve is basically already a green funding curve. And for us, it's very difficult to assess the impact on the greenness or on the label. Whereas if you look at other issues, basically that don't have a green funding curve, and their business model is not linked only to sustainability. They have an ordinary curve, and if they issue a green bond, then of course the advantage of them, also based on the limited supply, is higher. But in my point of view, in general, we see the tendency that a green label offers cost benefits in terms of pricing for the issuer, and nota bene without taking into consideration also the cost that it takes for the reporting, etc. But in general, we see a pricing and the tendency that a label helps in terms of the pricing.
Very good. Now, if we look at the reporting, and we have already discussed this topic before, now from your perspective, how does all of this affect your reporting? The fact that you issue the two types of bonds, are you doing a different kind of reporting for the two types of bonds? Could you share your views on your reporting experience in that field?
Yes, on the reporting part, it's clear that the green bonds require more reporting, and so we have to follow, the bonds have to follow the ICMA green bond principles, but also the EU green bond standards. And that's why, as you already mentioned, we need to report on the use of proceeds. We need to create allocation and environmental impact reportings, etc., etc. So it's quite some work to do. For Eurofima, it's a little bit more easier because the asset that we finance are trains, so it's a little bit easier to assess the impact. And on the standard bond side, we do not have additional requirements in terms of reporting. We just publish on our website the breakdown by investor type and region, and that's it. And having said that, despite the fact that the reporting for green bond is more expensive, it also adds value that we then can basically use later also for investor relations, for marketing purposes. So of course, it's an extra effort to report on green bonds, but there is also an advantage of doing so that you can use in other fields.
Excellent. Now, if we move over to investors, investors are obviously extremely important. Now, would you say that you see a difference in the investor types when you compare your labeled and your non-labeled issues? Do you see different categories of investors for both?
So the investor types highly relies on the tenor of the issuance, the currency of the issuance, but also, as you said, on the label. So we see a strong participation of ESG investors in our green bonds, especially, where we basically see orders mainly coming from asset managers and insurance located in Nordics, Germany, France, where sustainability is more advanced, that basically participates in our issuance. And most of them really manage dedicated green funds. And I doubt that we would see all of them in a non-green issuance, because they simply also have to tick the box that it's labeled. And if we speak about, in comparison to our US dollar non-green issuance, we clearly see there that the main investors are central banks and official institutions. So there is a clear difference. It's not only because of the label, there is also other factors that we need to consider, as I said, tenor or currency. But there is a clear tendency that the investor space in a green labeled bond is more tilt to ESG investors.
So would you agree that we could say that overall investors do rely on these labels when they invest?
Some definitely do, as they have strict investment guidelines, and the label is just a box that they need to tick. Some don't, and they see really Eurofima as a climate-aligned issuer that is at the core of sustainability. And just if we speak about the recent development and how I see the outlook, is that there is clearly a shift towards a more holistic approach on the issuer, than rather only taking into consideration the label itself. So we clearly see the shift towards a holistic sustainable concept when we speak to our investors and we do in our investor relations course. And in this respect, LGX is a very important step that basically facilitates all of this discussion, moving a little bit away from the pure label discussion towards what is the issuer doing in terms of sustainability and climate.
Following up on that point, from your perspective, Robert, how important would you say is the overall ESG profile or the ESG rating of an issuer today in the capital markets?
As I said, it's important, and the ESG rating is the importance is increasing. And I think one thing is that the companies also need to report and define their business activities towards clean action plans and on the goal that they want to achieve for their climate targets. And this is better reflected in an overall ESG rating, which takes into consideration the whole activities a company or an organization does, compared to only a labeled bonds. But to me, the labeled bonds were really the starting point for helping raising awareness in the financial industry towards the climate topic. And this was really an important step, that sustainability takes an important role in the investment decision process. But ESG ratings or the ESG compliance of a company is more important going forward. And I can also speak about the activities that we do at Eurofima. So if we speak about risks and our investment decision process, we are not only looking at credit risks and interest rate risks in our investment decisions. We take ESG risks as one of the risk factors into our investment decisions. We first of all do not invest in non-compliant issuers with the UN Global Compact. Second, we have to integrate ESG considerations in all our investment decisions. And thirdly, we also seek the dialogue with the positions that we have in order to understand what they're doing in terms of sustainability. And I think that's something which is all these three parts you cannot do only if you only invest in labeled bonds. So you really need to take into consideration the whole business model and strategy of a company.
Yeah, thank you very much. Now, if we look forward future, Robert, in your view, what can we expect from the so-called climate-aligned issuer universe? How do you see the climate-aligned market evolving?
Yes, so the trend is obvious. Organizations and companies need to disclose their actions, so what they are doing. And this tendency is not only supported by the ESG investor, but also by the regulators, by the governments, international organizations. So they want to know what the company and organization is doing in terms of climate alignment. And I think the first step is really that we need to break the silos within the organization, and they need to start to thinking this topic holistically, that they engage in the organization with each other. And then they also need to put sustainability at the top level in the management's agenda. And the more and more this is the case, the more and more climate-aligned business model we will see. And out of that, more climate-aligned issuer will emerge. So I think it's a slow process that started with labeled bonds. Now you need to think more holistic, how to integrate sustainability in the business model. And that's the future basically then also for the financial climate-aligned market, to let's put it that way. And just also to speak about Eurofima, what we did is we really aligned all our activities in terms of corporate strategy, in terms of investment activities in the Treasury and Asset Management Department, and our presence in the capital markets towards sustainability. And we really want to be recognized as a holistic, sustainable issuer with a holistic, sustainable business model. And I hope that more issuers follow that path, and then we see more climate-aligned issuers in the future.
Very good. Thank you, Robert. And then my very last question to you would be, what does it mean for you as a climate-aligned issuer to be now on our new Lgx climate-aligned issuer section?
Yes, thanks. So sustainable finance is still in its infancy. And this Lgx platform connects like-minded issuers and investors. And that's really an important platform, basically, where you put the focus on sustainability, which is our core identity. And that's why we shifted all our issuance to that platform. So we all list all green bonds at Lgx. And we want to also play an active part in the development of the sustainable finance market. And our mission basically is a strong commitment to environment and to our society. And I think I can see the same mission if I look at the statements of Lgx, that you want to provide issuers, asset managers and investors with an environment for bonds and funds which are green, social, sustainable. That's exactly our mission as well. And that's why I think it fits perfectly to what we are doing. And that's why we moved all our listings to Lgx.
Excellent. Thank you very much, Robert, for this contribution. I think it was extremely interesting to get these very clear and instructive insights from Eurofima. Again, thank you very much for this. And then I would move back again to Chiara, maybe for Q&A so part.
Robert and Carlo, indeed, I do apologize for the delay. Most of the questions, there have been quite a few, have been answered in written, hopefully accessible to everyone. In the interest of time, I would still like to take at least a couple open to the floor. One of which concerns us, and I will take it directly, is when are we going live? Is it today? So the website is actually up and running. You can have a look at it already as from now, and the link has been shared via the chat box. And the other answers we had for our model that has an immediate impact is if we are going to display the level of strongly or fully alignment. Of course we are. We're going beyond that. We're actually giving the exact percentage of alignment as calculated by CBI. Then there was another very interesting question for Sean. It's in relation to the science-backed methodology that you're taking to classify the universe. You did reply yourself that it's not just ambition, of course, it's about reported impact metrics. Maybe you want to elaborate a bit on that, and maybe you can link it to what is happening at the level of the European taxonomy. Is there some sort of common way of seeing things? Will the two set of taxonomies ultimately, to a certain extent, converge? What's your view on that, Sean?
Thank you, and thank you for the opportunity to expand a bit. Initially, we're looking at assets, that is, stuff that we can actually point to in the ground that exists or is being built, like a solar farm that already exists or a wind farm that's in construction and it's that advanced. We're not looking at promises or strategies at this stage. However, where we are going over this year, and we will then provide further data, of course, to the Luxembourg Green Exchange, is assessing the forward strategies of companies and seeing where we can get confidence about those deliveries. We're still working on a framework for that, but it's very clear that we've had an enormous amount of success over the last 18 months with more and more companies coming out and committing to net zero targets by 2050, which is fantastic. Some of those ambitions are not actually strong enough. If you commit to a net zero target in an area like steel, but you continue to build gas-fired power stations to replace coke rather than shifting to green hydrogen or hydrogen, then you may actually be taking the wrong CapEx direction if we are to meet our targets for that sector. So that's the sort of work we're doing now, trying to understand the benchmark trajectories, working with our colleagues at the Transition Pathways Institute and other organizations, what the benchmarks are for sectors, and then giving us a framework to be able to assess corporate strategies and corporate ambitions to see whether it is ambitious enough with what we've got to do in Europe to meet our targets. And that will allow us, very much so, to be able to bring in a bigger universe of companies into this particular framework, but not there yet. So today it's very much solid assets or actual projects which financing has been sought for. For example, if Deutsche Bahn issues a bond to build a high-speed rail link, and the use of proceeds is very clear, it might take a couple of years to build, we'll count that. But it won't be a promise to build it in 5 or 10 years' time that will count. I hope that makes sense, Chiara. It's very sharp, and you've got to be able to find the project at this particular point to get included. Very solid indeed.
It does indeed.
Investors a lot of confidence.
It does make a lot of sense, Sean, indeed. And we want to thank you for the leadership that you've been having since the beginning of the market, and that you're still, in which you're still putting the bar higher to serve the market with these fast evolutions.
And I'm so happy to support the world's #1 green exchange. So it's a marriage made in heaven.
Talk about leadership.
So much, Sean.
I think it's time to wrap up. So I would like to leave you with the main messages that underpin the creation of this new section at the Luxembourg Green Exchange. So we said Lgx will start as of today to give visibility to both public and private companies that derive between 75% and 100% of their revenues from climate-aligned activities. As a reminder, these products are only identified at the level of the issuer, and more specifically to concrete analysis of their revenue streams. So far, at the opening, we have already 23 climate-aligned issuers on the Luxembourg Green Exchange, and of course, this number is set to raise in alignment with the dimension of this pool of issuers and opportunities. We are absolutely confident that relying on CBI methodology for the screening and for the classification of these issuers will allow us to contribute not only to the extended supply and more satisfactory supply of opportunities to ESG investors, but also to ensure a safe framework of transparency, again, at the level of the screening of the activities of the issuer. So transparency will continue to underpin Lgx, as it has been the case since the very beginning. And Again, we are not making any artificial discrimination or giving a competition outlook amongst the labeled universe and the climate-aligned issuers universe. We're just supplementing the market with an additional pool of equally interesting opportunities that could fit ESG mandates. So we believe it's a win-win for the market. And with this in mind, I would like to call it a wrap and to thank all of our speakers for the fresh insight you brought into the project, and to our events team for making this event possible. So thank you very much and enjoy the rest of your day. Thank you, Julie. Thank you, Sean. Thank you, Robert.
Thank you very much. Bye-bye.
Thank you very much.
Bye-bye.
Bye-bye.
Thank you.